3 times a day, every weekday. This happens on RNZ.
How's the New Zealand dollar looking?
So currently at 56.20.
New Zealand dollar also buying
57.2 US cents after touching 55.7 yesterday. It's at 87.
In a way, this is easy to understand, right? You've got $100, you want to travel to the USA, you need to convert it to US dollars, and you get 57, minus a bit of commission. But it's also not really easy to understand at all. Like, why do different countries have different currencies? Why do they fluctuate so much? Why did a mini budget in the UK which promised tax cuts lead to this?
The British pound has crashed to a record low against the US dollar as markets react to the UK's biggest tax cuts in 50 years.
And then this.
It's at its strongest in about 2 decades when you compare it to a sort of basket of its kind of major trading partners. That would include the euro, it would include the yen.
Why are there so many rain clouds over so many of the world's currencies at the moment? And why is the sun shining on the US greenback?
The dollar is very strong. That's the takeaway.
I'm Emil Donovan, and today on The Detail, the many factors that go into determining the value of a dollar. Giles Beckford is RNZ's business editor. Giles, at a fundamental sort of level, what are currencies?
They are, I suppose, in the broader sense, they're stores of value. In other words, they tell us that the note or the coins or the swipe of the EFTPOS card, they will buy you so much. And your economy is worth so much. This is what's in circulation. So in a very basic sense, that's what a currency is. And it could be not just a dollar. It could be in centuries, millenniums gone past. It was shells. It was bits of wood, stones, ceramics. And China, of course, is credited with bringing what might be regarded as some of the first currency that was invented and used around the world. But we've seen it right through ancient history. Here is something, it's a means of exchange, and you and I can do business in buying and selling goods and services with that currency. So that's the most basic use of currency.
And so is the benefit of a currency that, where previously trade might have been, I will give you some coffee beans and you give me some kiwi fruits. But that is dependent on me wanting coffee beans and you wanting kiwi fruit.
And both of us agreeing that my 10 kilos of coffee beans equate to your 5 trays of kiwi fruit.
Exactly. Yeah.
And you turn to me and say, no. Actually, I'm getting really good hides. I'm getting 10 hides for my kiwi fruit. So actually, you've got to pay me more or else I'll go buy hides. That's a very simple equation there where you're making a judgment against another currency. In this case, it's a hide, as opposed to my coffee beans.
Right. And so currencies in our sort of modern interpretation of them are sort of a neutral thing that we have imbued with value, and all other goods that you might want to purchase are hooked into that neutral thing in terms of how much of those goods this neutral thing, this currency, can buy.
Yeah, it's a means to an end. It's a convenient and simple way of being able to say, this is how we value services, goods in our economy. They may change, and we won't go into the reasons that might happen, but from time to time, we will agree on the value of this, and here's the convenient way of doing the deal.
Chris Tennant-Brown is a senior economist at ASB. I asked him what factors dictate the value of a currency.
Well, at a very simple level, supply and demand. If we're talking about what's a New Zealand dollar worth relative to a US dollar, literally thousands of people meet in the market wanting to buy and sell currencies for all the various reasons they do, be it trade, travel, speculation, investment. And so there's a meeting point where where you can determine the price of $1 versus another, and that's what happens every single day.
And so what are some of the factors that would make a currency strong? Like what are the things that would influence whether a currency trader wishes to invest in a certain currency or not?
Well, I think you've got to broaden it up from a currency trader and think what makes people want to buy or sell their dollars and buy or sell someone else's. So a currency trader is only one aspect in that. Sure. There's people that are carrying out trade. There's people that are travelling. There's people that are speculating. There's people that are investing. What determines what they'll pay is how strong they feel about what they want to do. Part of that feeling is, at the moment, that I think is prevalent in the market is fear. There's a fear about a global economic slowdown. There's fears about inflation. And that tends to favour currencies like the US dollar, which is so strong at present.
Why doesn't everybody in the world just use one currency? Why don't we have like a global dollar?
In many cases, people might say that the US dollar is a de facto world currency. It is the currency of commodities. It is the world's biggest economy. But what it does mean, of course, is that what happens in the US economy would then start to dictate the policies in a lot of countries. Because if you use, say, a US dollar, or you are pegged to the US dollar, and some currencies are pegged to the US dollar. So when it goes up, they go up. When it goes down, they go down. But of course, countries are surrendering some of their sovereignty, their economic and financial sovereignty, if there was only one global currency, because circumstances in New Zealand are different from what's happening in large parts of Asia or in Africa or the Middle East, and it's probably not feasible or sensible. We'll wait and see. In centuries to come, perhaps we'll find a way of doing it. But for the time being, in the current economic structures that exist and the way that we trade, then you have to say that each country, or many countries, want to have their own currencies to suit their own economic imperatives.
You mentioned that the US currency might be regarded as the sort of de facto global currency, and it's the currency of the commodity markets and so on and so forth. Why is that?
It's the world's biggest economy, right? What Uncle Sam says, what Uncle Sam does is so influential, it's so dominant throughout the world. In the past, when people have wanted to look to an economy that was going to drive the world, that was going to sustain trade, it was the United States, or it has become the United States. In centuries past, in fact, it was probably Britain, but now it's the United States. So what they do really sets the pace, the tone for the rest of the world. And you have to say that being such a large economy, then of course there's safety in that. If you are to buy US assets, then you know that you've got a degree of security and strength about those assets that will stand you in good stead. Is
having a strong currency a uniformly good thing?
No, it's not always a good thing, although countries tend to have a degree of economic arrogance, which is that our economy is going so good that we should have a strong currency. It's a sign of a strong economy, and you stand tall in the world. But the reality is that there are consequences to that. We've found that a high currency, of course, it dents your export returns because you get fewer New Zealand dollars, for instance, for a US dollar if we've got a high exchange rate. Conversely, a lower currency at the moment, although New Zealand dollar is sitting around 55, 56 US cents, that's actually not too bad because it means our exports are actually earned, when they're converted back into New Zealand dollars, there's a bigger pile of them. If you have a high currency, a high valued currency, it means that your interest payments are probably lower, so your foreign debts aren't as big a burden on you. Conversely, A lower currency means that your interest payments, assuming they're denominated in US dollars, then your interest payments will cost you more. In the end, you feel a bigger burden. So there's a balance there. You find that in some countries, Japan's a perfect example at the moment, where their government, which has been keeping interest rates pretty low and have escaped the pandemic in passably good shape with lowish inflation, but they are artificially keeping their currency low in order to boost their exports.
Well, the yen tumbled to a 24-year low against the dollar this week, a level not seen since 1998.
The biggest reason for its weakness is divergence of monetary policy. While other central banks have moved benchmark interest rates higher, Japan's have remained ultra-low. The exchange rate isn't part of the Bank of Japan's mandate. The central bank is focused instead on keeping a lid on inflation and supporting growth, most recently impacted by the pandemic.
In the current environment, they're looking to maximise that, so they're intervening to suppress the value of the Japanese yen. And that's why, for instance, our exchange rate against the Japanese yen wasn't so long ago, was sitting at decade highs, because Japan's moving to keep their currency artificially low. It can get into tit for tat. You have a thing called currency wars in the past, where countries have moved to keep their currency low in order to get a trade advantage. They attract retaliation. Donald Trump, as president, got very antsy about that very thing against China, where he accused China of keeping its currency low in order to boost its trade returns. And he said those were at the expense of US producers, the US economy, hence his move in part to retaliate with the imposition of tariffs.
Bring this back to the idea of having a strong currency is not a uniformly good thing. It is a shorthand maybe that, like, if you're an exporter, if you're Fonterra or you're Zespri or whatever, you want the dollar to be weak, because then you're getting more New Zealand dollars for your product, essentially, when you export it. Whereas if you are an importer, like a Mediterranean food warehouse, or if you own a building company and you import lots of materials from overseas, you want the dollar to be strong, because then you're getting more bang for your buck.
That's what you would, in the most simple sense, yes, that's the sort of trade-off that you'd like. If you're bringing it in, then bringing in goods and services, then of course you want them as cheap as possible, because you want market share, you want to sell them at good prices to get people parting with their cash here in New Zealand. But there's a balance there, and people will take businesses, of course, there's a whole industry called hedging, which people will engage in order to lock in prices for foreign exchange for the value of goods and services, so that they're protected against volatility and wild swings. Air New Zealand is a perfect example. Jet fuel is priced in US dollars. Air New Zealand will go out, it will buy this hedging, which is a form of insurance. It will specify that these contracts buy the US dollar at, say, 65 cents to the dollar. Now, the world price for jet fuel may fall, in which case Air New Zealand might say, well, we're out of pocket, because the rate that we were pegging was 65, but in fact, the price of a barrel of jet fuel is now 75. Yeah. Right, so they're out the money, but if it were to fall, say, to 55, then they've actually protected themselves from that. So there's swings and roundabouts.
Like a fixed versus floating mortgage rate in a way. Yeah.
That's right. So people are trying to protect themselves on that sort of thing. And there is no desirable level. Right? Yeah. In the end, if you believe in the free market, then, I know that at times that can be exceedingly difficult, and perhaps, and at times, such as now with volatility, people believe even less in the free market. But the point is that when things move around, you've got to take the good with the bad. But there are products there that will help people to at least mitigate the worst excesses.
You talked earlier about how the past 6 months have been particularly turbulent on exchange, on the currency market. Why is that?
Uncertainty, they would say. People, when things become uncertain, then just the general sentiment has people going for safety, and the safety is US dollars. But one of the key issues that we've had this year, not just the past 6 months, but this year has been inflation and the move by central banks around the world to raise interest rates. New Zealand started a little bit earlier than most. We started a year ago with interest rate rises, and it was about that time when, with local interest rates rising, that foreign investors were saying, well, not too bad. This looks an interesting market. We can make some money here, because New Zealand's interest rates were starting to rise in advance of the rest of the world. And so people were saying, well, if we invest in that New Zealand asset, then of course we're going to have to buy New Zealand dollars to pay for it. So that helped to support the New Zealand dollar. But this year, of course, we've seen the Reserve Bank of Australia.
The Reserve Bank surprised many economists by raising the cash rate by 0.5 percentage point, the biggest hike in more than 20 years, with warnings of more to come.
Bank of England.
With inflation now expected to be in double digits for months, the Bank of England have raised interest rates to the highest level since 2008.
And the US Federal Reserve in particular.
Just moments ago, the Fed releasing another interest rate increase of 0.75 percentage point. This is the 5th time the Fed has raised rates this year, and based on a forecast from Chair Jerome Powell, there are likely 2 more increases still to come.
That means that US dollar assets, their interest rates, they look more attractive. So, of course, money is going towards the United States because that's where the yield is, that's where the profit is. And then this is where you're comparing the rate of change, interest rate rises in the United States against the rate of increases in New Zealand. And you're seeing that the Fed's doing faster, is probably going to go a little bit further than New Zealand. And so from that point of view, you could say, well, that's where the money is. The money is in US dollar assets.
Another sort of real-world example that's happened over the past couple of weeks is the bottoming out of the British pound, which has plummeted to historic lows. Why has that happened broadly?
Loss of confidence, we'd have to say. The fundamental issues that have come through in the mini budget that was put forward was essentially cutting taxes, but they were unfunded, right? And so the implication was that they would have to be covered by borrowing, which at a time of high inflation is absurd. And the way that a lot of British pension funds have been set up, with the tumbling of interest rate yields, the value of the bonds that they hold in their pension funds, meant that some of them actually had their backs to the wall. There was talk that some of them, if the Bank of England hadn't stepped in, that they would have failed. Now, that's where the Bank of England started, or said last week.
Now, on Wednesday, the Bank of England made an emergency intervention in the markets, saying it would start buying £5 billion worth of long-term government bonds for an initial period of 13 days, around £65 billion total.
The last thing you want in an economy such as Britain is to see pension funds with hundreds of thousands of people going broke. That's just untenable economically, financially, morally, and politically. They needed to step in. But in that environment, in the uncertainty, with the weakness that was present in the British economy, people were dumping the pound sterling. They're saying this is no longer, the sure bet. This is no longer, it's not as safe an investment as we thought. It's not as safe a currency as we thought. Better to actually go for something that is stronger and more stable. The US dollar will do, thank you, or else we might buy the euro, or we might buy the Swiss franc, which is always a favourite at times of crisis.
Right. Okay. So Britain basically it unveils this mini budget which contains lots of spending, and it's unclear how they're going to pay for it. So the inference is that they're going to pay for this by borrowing that money, and currency investors are thinking, oh boy, we don't like all of the unknowns that there are here. Stability is our is our best friend in a way, and upside, stability and upside are what we're looking for. You can't provide that, so we're going to take our money somewhere else. We're not going to invest in your currency, in your country, in a sense. We're going to put that money somewhere else, and then we're left with the old sort of supply and demand kind of thing, where Britain has currency that people don't really want, and so the value of the pound falls.
That's a good summation of it. And the other thing, of course, is that people who had invested in British assets, for instance, they may have bought pound sterling at a more expensive times, so that they're sitting on potential losses there of perhaps hundreds of millions of pounds. The last thing they want to do is to be caught left with the parcel when the music stops. And so they'll sell their assets in order to preserve their own financial positions. And that's not an uncommon move, not an uncommon reason for currencies to rise and fall. And on that basis, as you say, uncertainty, weakness, they're two of the big enemies of currencies that trade around the world.
And I mean, the drop in the pound was very dramatic, and so understandably it caught the headlines. But the pound is not the only currency that's been. Actually, many currencies have been dropping against the greenback, haven't they? The South Korean won is at a 13-year low. Japanese yen was at a 24-year low recently. So it's not so much that the British pound is uniquely weak; it's that the greenback is uniquely strong.
Yes, in particular, that's a very good way of just putting it. These other currencies, they're not too bad, but the greenback, it looks super strong. That's where we want to be. That's where we need to be, for a variety of reasons. Remembering that a lot of currencies aren't traded necessarily for the innate value of, the price of kiwi fruit and butter and the like. They're traded because people are shifting tens of millions of dollars around at any one time, doing financial deals, doing investment deals, just speculating as well. So, all these things come into play and have influences on currency levels.
Where do we come into all of this? How have we been tracking in the recent past? And is there any indication as to where we might go in the short-term future?
Although New Zealand dollar is one of the 10 most traded currencies in the world, we have to say that much of what influences the Kiwi is out of our control. It's in a reaction to events overseas. In the big global currency pool, we are but a cork that bobs along the waves. Right? When things are reasonably quiet, when our prospects look good, when dairy prices are high, then and the economy is performing well, then we find that the New Zealand dollar tends to rise on that. Our interest rates, of course, are higher than many other developed countries, say through Europe or the United States. That tends to attract some investors who are seeking a higher return. But when things get jittery, when things become uncertain, when you don't know which deficit is going to hit which fan, then of course people go, look, I don't really need to worry about the New Zealand dollar, or perhaps even the Australian dollar at this stage. The main thing that we should be looking for to preserve our pension fund, the value of our assets, is what's happening in the United States. That will dictate what happens.
That's it for today. I'm Emile Donovan. The Detail is public interest journalism funded through New Zealand On Air and produced by Newsroom for RNZ. You can get us downloaded free to your mobile device every weekday from any podcast platform. Today's episode was engineered by Blair Stagpool and produced by Sarah Robson. Bonnie Harrison is our associate producer, and thanks to Giles Beckford and Chris Tennant-Brown. Mā te wā.